So in today's video, I'll be giving out some rules with respect to trading and with respect to trend trading in particular for the year 2021. So these are some of the guidelines that I use in my own trading, and I'll divide this particular video into 5 sections, and for each section I'll put out some charts for you so that you can understand this better. So the first section I'll discuss is about time frames. Now, one of the most common mistakes, especially if you're a part-time trader, you're not into full-time trading, is looking at something like a 5-minute time frame chart, 10-minute chart, 15-minute chart. Let me tell you, that is not at all required. Now, like I explained in the last week's video, because I expect volatility to go up this year, I think a daily time frame chart would be much more suitable, especially if you're not a full-time trader. Yes, if you're a full-time trader, you can look into shorter time frames as well, but you do need a lot of experience to navigate around price with respect to whatever happens in the short term. So my advice or my recommendation would be to stick to daily time frame chart. And yes, you can use something like a 60-minute time frame chart in order to time your entry and exit better. If you just look at what has happened in the last 6 to 8 months, the entire trending structure has been very clear on something like a weekly time frame chart, daily time frame chart. Whereas if you look at something like 5-minute chart, 15-minute chart, even something like a 10-minute chart, there have been instances where markets have fallen off quite rapidly, and that would have actually shaken you out of your positions. So unless you were tracking something like a daily time frame chart, you wouldn't have been able to handle the kind of volatility that has played out over the last 6 to 8 months. And that is why I'll tell you that even heading forward with respect to trading in the direction of trend, you should only be sticking to something like a daily time frame chart in order to avoid all the random noise that goes on in the market.
Click on the subscribe button and bell icon to get instantly notified when a new video is uploaded. Thank you for subscribing.
Now let me tell you one thing, that institutional traders and investors just don't bother about 5-minute, 10-minute or 15-minute time frame charts. Their trades are from a little longer term point of view, and therefore it is much easier to visualize trends, to spot trends, and then to get into those stocks that are trending well, especially if you're tracking something like a daily chart or a weekly time frame chart. So don't commit this mistake, at least in 2021. Just try and trade the daily time frame chart for the next 4 to 6 months, and you'll automatically see the difference it makes in your own trading process and in your own psychological process. Now, the second section that I want to discuss is about trend. Now, what I'll say here is that as a trader, you need to develop the psychology of trusting the market and trusting what the price is doing at any given moment. See, let me tell you, in stock markets, trend is the ultimate truth, and those who don't understand this do not survive for long in the market. And you can take a lot of examples. There are a lot of people who were calling for tops at 9,000, 10,000, 12,000, 13,000, even at 14,000. But look what the market is doing. If you had simply trusted the trend, simply looked at daily time frame chart and studied the price structure, you would still be in the market. And who knows what is the top in the market? That is what is the essence of trend trading, where you submit yourself completely to the market and follow the market wherever it goes. It does not matter whether the market tops out 10% from here, 20% from here. The important thing is to trust what is going on and then having the patience and discipline to follow market wherever it goes. See, the one quality that good traders have in the market is that they are very good at reacting towards what the market is doing. They are not interested in predicting where the market will turn or where the trend would end. They are only interested in following what the market is suggesting and then having the patience and discipline to hold positions during that period. And this is what separates a amateur from a professional trader, wherein a professional trader realizes this, that he has no control over the market and he has to ultimately follow what the market is suggesting. So in many ways, trend is actually market's way of communicating with you. It is telling you clearly where price is heading over short term, medium term and long term. And then you have to develop the psychological maturity to submit yourself to the market and then simply follow where the price is heading. It's easier said than done, but then trading revolves around very basic, very simple concepts, and don't try and complicate it by using tools that are predictive in nature. Rather, I would tell you, you should master those tools, something like moving averages, something like momentum indicators that actually tell you what is the direction of trend, and then you can work upon developing some sort of psychological balance where you can trust the trend and build positions accordingly till the time trend ends. So my message to you with respect to this particular topic is very simple. Just believe in the market with all your heart and soul and just see what happens. I can assure you, over the next 4 to 5 months, you will improve a great deal in terms of stock selection, in terms of knowing when the trend is ending, in terms of holding positions with conviction. If you align yourself with the market, that is the direction of the market, that is when you will start seeing actual growth in your account. Please don't go behind mean reversion strategies. Don't go behind calling tops and bottoms in the market. Just focus on the middle portion of the trend. If you can just do that for the next 2-3 years, let me tell you, you will surpass your wildest imagination in terms of how much your account can grow. And don't measure your success in terms of profit and loss. That is something I'll discuss in the fourth section of this video. But measure your success in terms of how much risk you're taking and then how much reward you're getting for that trade. Again, this is something I'll discuss in great detail in section 4, because this is again one problem where a lot of retail traders struggle. So for those of you who are channel members, please note that gap trading part 2 will be released next week. Please keep your notifications on. And please be active in the community section. That is where I discuss what stocks and sectors I'm focusing upon, and I update daily about overall market structure and the structure of sectors. And for those of you who are not channel members, you can just join channel membership for 1 month and watch all 34 videos in price and volume analysis series. So these videos are spread out across 3 main playlists. The first one is price volume analysis. The second one is application of price and volume analysis. And the third series is about pullback trading. Now the third section that I'll discuss is what are the kind of stocks and sectors that you should be focusing upon. Well, let me tell you that there are a lot of free tools that are available. You don't need to buy any expensive software. On something like tradingview.com, you can have something like a relative strength indicator to find out which stocks and sectors are strong. Especially if you're a community member, currently that is the topic I'm teaching you on day-to-day basis as to how to analyze which sector or which stock is strong in the market. In case you're not a community member, don't worry. I've done a lot of free videos on comparative relative strength. Please watch those videos because that will enhance your understanding about how to measure strength of a sector and a stock. Now, the second way you can analyze which stocks or sectors are strong is by taking something like a 52-week low high as an indicator. So you can just track those stocks that are near 52-week high level, and you can only focus on those stocks to trade and to invest for the long term. Because when the stock is near 52-week high, market itself is telling you that there is something going on in that particular stock that you should pay attention to, and those are the stocks that are exhibiting the strongest trend in the market, and that is the reason why those stocks are at 52-week high level. A common mistake that retail traders do is they only focus on those stocks that are at 52-week low level. You have to think first that there is some reason that market is pricing those stocks so cheaply, and with respect to the overall market, the market is trading near 52-week high. Why these specific stocks are trading near 52-week low level. So get out of the mindset of trading cheap stocks, trading those stocks that are at 52-week low level, and start focusing only on those stocks, especially in a bull market, that are near 52-week high level. Again, this is a subtle shift that you can make in your trading that can do wonders to your trading account. See, in the previous video, I've already explained why valuations is something you should be looking at very carefully, but you should combine valuations with price action. I've also told you the importance of volume in the previous week's video. So please watch that video if you've missed it, because that will enhance your understanding as to how to select stocks and sectors and how to trade those. Now, the one thing that I sense in the market among traders I interact with is that a lot of traders are getting scared about where the market is. See, let me tell you, you can never know when the trend ends. Currently, as of recording, Nifty is at what, 14,400, 14,500 thereabouts. You never know if tomorrow a top can form in the market. The thing that you can do is you can have your trailing stop in place. You have protective stop losses, and those will get you out of the market in case a fall comes about. Don't get stuck with what happened in 2020. Don't get stuck with what happened in 2008, because I know even those corrective phases are still fresh in people's memory, and they are never able to let go of that phase. So don't do this mistake. You have your stop losses to protect yourself. Just believe in the market, just believe in the trend, and wait for market to signal when the trend is going to end. Again, I've given very simple data points in the last week's video. Please check that video, because that will again help you time your exits better. Now, the fourth section that I want to focus upon is as a trader moving away from the mindset of profit and loss and moving towards the mindset of risk and reward. And again, if you watched my free videos, if you're in the community section, there is just one thing I keep teaching, and that is the importance of risk reward and how you should be structuring your trades, selecting specific stocks where risk and reward is higher. So profit and loss, in my opinion, is the biggest myth in the market, and it is the biggest factor because of which retail traders gravitate towards something like futures and options. They take a lot of positions which is not meant for the account size, and they eventually ending losing up all the money. So if you keep tracking M2M, that is mark to market figures, on a daily basis, then you will move away from price action analysis and you will move towards a mindset of greed and fear. Now that is one thing that will make you either take a lot of positions or exit a lot of positions prematurely. So don't do this to yourself. This is the single biggest mistake a lot of beginners make in the market. It does not matter how much money you make in the short run or in the medium run. What matters is how much money you are risking upfront for a trade and then how much return you're getting over it. If you just shift towards this mindset of analyzing each stock with respect to risk and reward, let me tell you that is going to do huge wonders for you in your own trading. So moving away from profit and loss and mark to market figures and towards something such as risk reward, analyzing trade structure and then placing your bets in the market, this is a process that involves a lot of discipline and a lot of patience. Don't think you can do it from tomorrow, because you can understand why people only think about profit and loss, because that is how they think about stock market. Well, stock market is not a place to make money. Let me tell you very frankly, stock market is a place where you first need to learn how to preserve money. And this is something that I'll be explaining in the next video. So for the time being, just tell yourself that you're going to get away from the mindset of how much money you're making and losing. That is, don't get trapped between greed and fear, and then move towards understanding what is the risk in the market in that particular trade and how I'm going to structure that particular trade. Now, the fifth section that I want to discuss with respect to trend trading is to not mix price action analysis and something like derivative data analysis. Now, this is again a huge mistake that a lot of traders commit, wherein they are looking at price action and then they are looking at open interest options data to determine whether the market will move up or move down. Let me tell you one thing, as it goes with other technical indicators in the market, it is price that determines what will happen in the market. Options open interest, or for that matter, futures open interest data will not determine what is going on in the market. So again, don't do this mistake when it comes to trend trading, because even in November, even in October, if you see, options data was not that positive, and despite of that, market kept climbing up. And that is the main reason why on social media and televisions you always used to hear that 11,300 is resistance, 12,000 is resistance, 12,500 is resistance, 13,000 is resistance, because that is what options data was reflecting. And look, where market is today, it is at 14,400, 14,500, despite of the negative options data that was prevailing. So if you want to become a good trend trader in the market, then stop looking at options data. Just trust what price and volume suggests to you, and then start trusting the direction of trend. If you start doing this, your growth will be really quick. You will evolve as a trader, and whatever market then does in the short term or medium term, you will be better equipped to handle that. Now, since we are on the subject of options data, with respect to longer form of trading, I'll someday explain how options data can be useful. But in the short term, or at least trying to trade the trend over something like 6 months, 4 months, options data is just not useful. On the contrary, at every minor dip in the market, options data will actually suggest that there is overhead resistance and you should be exiting your positions. So that is why I've combined all the other points with the fifth section of whatever I've discussed today with respect to options data, because I feel a lot of retail traders make this mistake of over analyzing what options market data suggests, and they don't pay that much attention to what price and volume is suggesting. So heading forward, just take these 4-5 points that I've discussed with respect to trend, with respect to how to analyze a sector and stock strength, how to trust the trend in terms of making a switch towards risk and reward, and moving away from profit and loss. If you follow these steps, you will be on the right track in 2021, and definitely your trading will improve over the years. So do check out my previous video that I've done last week. That will also help you understand the overall market structure better. So thanks a lot for watching this video, guys. Kindly hit the like button if you find the content useful. Have a great weekend ahead. Take care and be safe.